Assalamu alaikum and very good morning to my delivered lecturer and my friends, to my lecturer Dr. Arifatul Hosn bin Muhammad Arif, and to all my friends. In this video, I'm going to explain transfer pricing, case 5, the Caribbean rivers. Let's first read the questions, then after that, I will analyze the answers. The first question, how can the majority shareholder shift wealth through accounting cost allocation and transfer pricing? The second question, given the wording in figure 5 with respect to the taxation of related party transactions, to what extent is Caribbean powers tolerance to tax reassessment? And last question, what are the implications of the composition of board members to the reporting of the CFO, assuming majority of the board in managing of representative of majority shareholders. Now, let's begin answering the first question, which talk about how can the majority shareholders shift wealth through accounting cost allocation and transfer pricing. Actually, cost allocation is the procedure of assigning, accumulating, and identifying costs to different cost objects, including programs, products, and departments. It can be said that it involves the identification of cost objects in an organization, determining the costs that are incurred by all the cost objects available in an organization. Once these costs are determined and identified, costs are assigned specifically to different cost objects on the basis of specific criteria. Shareholders can determine cost objects that are generating return, and they can assign costs to objects that are more effective, and it can serve to shift wealth. When it comes to transfer price, it is recognized or determined as a transfer cost. Specifically, it is the price at which different associated parties tend to transact with each other, like during the labor trade or the supply trade between different departments. Actually, transfer prices are considered when entities of a large organization are measured and treated as individually run entities. It is quite common for multi-entity firms to specifically consolidate on the basis of financial reporting. Still, they might report each and every entity individually for the purpose of tax. Let's move to the second question. Given the wording in figure 5 with respect to the taxation of related party transactions, to what extent is Caribbean powers vulnerable to tax reassessment? You may include an analysis of calculation here. You can see the figure in this table. Uh, According to the case scenario, business activities should be taxed depending upon the laws and the regulation of taxes by the government. In this figure 5, it is clearly stated that a company with the resident state can involve any other company in the business operation. In the second company, it is not an if the second company is not a non-resident company, then they will have different tax liabilities and variable. While on the other hand, if the second company with which a resident company it is interested to do business, it is a resident company, then both companies will have same tax policies implemented by the local or state government. In this case study, the second company is another resident company. Therefore, tax and liabilities are different than normal cases. The following figure 5, the non-resident company is generating a lower profit than a resident company. Moreover, the resident company is expected to generate at least the estimated level of profit from the physical year's sales. In case the company fails to produce expected level of profit, then they should determine inland revenue in a reasonable fashion, whether any additional profit should be deferred to be accessible income of a resident corporation. According to the U.S. tax laws policies, the non-residents of the U.S. are subject to pay the income that is generated from the operation executed in the U.S. The income source will determine the tax amount. See the following table representing tax of this case. Net profits before in 2008 was 30,642,350, while in 2009 was 27,479,055, while in 2010 was 28,735,200. The tax rate in the 3 years is a base is 30%. The tax expense in 2008 was 9 million, and in 2019 8 million, 2010 8 million point six. The net income in 2008 was 21 million, and in 2009 19 million, and in 2010 20 million. In the above table, net income is presented as the net value after deducting the tax expenses from the before tax income. Following the case study, the business organization Capital Powers is working in a state which has a tax policy of 30% deduction from the generated revenue income. Considering this 30% tax policy, we have multiplied the before tax income with the 30% and calculated the net income amount for the last 3 fiscal years. And let's move to the last question. What are the implications of the composition of board members to the reporting of CFO? Assuming majority of the board is made up of representative of majority of shareholders. A CFO is a chief finance officer of the company who deals with the financial matters including financial projection and cost allocation plans development. The CFO establishes business policies in the best interest of the organization to reduce financial risk and maximize financial outcome from the executed business operation through improved strategic action plans. The board of directors work alongside uh, with the chief officer and chief executive officer of the company. In the board of composition, we need to consider the prime responsibility of board members regarding reporting to the CEO and CFO. The following aspects should be considered in the board formation. First, board size. Second, board membership. Third, director independence. For the first one, board size. The board size should be optimal. Smaller board size will have advantages over large board sizes. However, board members should be efficient in the size is small, otherwise board members would not be able to accomplish the required activities appropriately. Normally, directors are selected from the majority of shareholders as their representative. For example, if a company A has the highest number of total shares in a company, then they can select the representative as non-executive board members. Second, board membership. Board diversity is also important while selecting board members. The board members should be selected while following the hiring and selection laws for the corporation by the state government. Lastly, director independence. Director independence should be also considered in the board composition. The board members should be able to work independently of management through a thoughtful and diligent decision-making process. This should be at least 3 non-executive board members who work while the chief executive officer and chief financial officer to deal with corporate business decisions. I hope my answers was clear and enough to answer the 3 questions. That was all from me. Thank you for watching.